Peter, let me ask you right off the bat, the trend has seemed to be going automating the trades, like mechanical trades. Would that be the way to say it? Which is what do you think of that?
I mean, it's great because obviously technology is fantastic for trading. Access to trades being cleared. I mean, before the old days, everything's done in key punching, right?
Yes.
So for a clearing firm, it's fantastic because you can get instant, not instant clearing, but it goes straight to the clearing house, right? So I think it's great in terms of transparency and speed for technology. And like our platform, where it's going into exchanges so fast, so I mean, there's some great things for retail clients now that we didn't have when we were there. And then access to all these different markets, right? And
Yeah.
all these different products, right? So like, you know, I think it's amazing in terms of that technology part of it.
Yeah. I mean, I think, from someone that's been involved in risk management for a long time and trying to teach students, well, like Options Omega, one of the things they're doing would be where students could do automated trading. But what I think, Peter, is what's nice about it is I can't tell you how many students I've had where they don't stick with something to learn the craft, or they lose a trade, they're done, or they don't stick with any kind of risk management. So for me, I think this is wonderful. It can get kind of the student out of the way of himself, right? That something that can actually stick with stuff. So I'm very bullish on it. I think it's
Well, as
wonderful
I
because
explained for some of our big traders, and you never want to talk to a risk manager, but I talked to them like it's all about trade for next day. You never know what tomorrow brings. Tomorrow, everything can change. Like as a trader, you have to do is you have to be able to trade for next day. So if your account is too leverage, right? The idea is that if your account gets liquidated today, you're done. You'll never have another chance. And
yeah,
things change so quickly. So what you have to do as a trader, you have to make sure, to your point of risk management, that you can trade for next day. Meaning next day you're in business, right? Because things can overnight change, and and you want to be able to trade. I
yeah.
think that's the most important part. To your point, yeah. If you don't have these firm guidelines in place and let your account go, oh, it'll come back, it doesn't come back, and then you're out of the game, right?
Well, and the other thing, Peter, what you say, I mean, we were highly motivated at the CBOE. If someone, I worked with the Nigerian brothers, and one of the things with them, if in the morning meeting, if I said I was going to adjust or cut the deltas at a certain point and I didn't do it, or someone didn't do it on a repeated basis, my main motivation was just like yours. We had kids, we would get fired, and we'd have to get a real job, right? And so that was enough motivation for us that, what the heck are we going to do? And so it's like you would be disciplined and stay with it. Whereas what I've noticed with retail traders is there's nobody they're really accountable to. So if they're short deltas and they should be adjusting and they don't, no one's really, you didn't have those repercussions, right? When you were starting out, if you
Well, I
were
mean, you lose your count, so that's good. That's probably catching up. But it's about short units too. Like in this kind of market, you can't be short units. You have to make sure that your units are covered. Like, because I had a guy a couple of days ago, was like, oh, it's not so bad. I'm long this, but I'm short this way further down. Like, it's about units. When you get these extreme volatility moves, those it's all about getting yourself not flat units, or if you can take your short units very small so you can still stay in the game. And that's part of the risk management, right? Of understanding your position, right? Where is your risk, right? Which we
yeah.
get pretty cool tools. I don't know if you guys use our risk analysis tab or tool we have on our platform on our cap report. I kind of built that over here, and I think it's great in terms of showing where your risk is a position, because margin requirement is margin requirement, understood. But sometimes the margin requirement doesn't cover the risk, right? And sometimes it overstates the risk, right? But the fact that you can do your own what if scenarios, like, okay, if this happens, vol goes up, or tomorrow those hedges come off, right? I think that's really important. Or you can just imply vows, really important to, then you can always factor in, okay, am I good? Am I meeting my criteria, right?
Hey,
So
Peter, what is that tool? What is that called again?
it's called a risk analysis tool, and it's
Okay.
on the tastytrade platform. If you go in cap report, you click on risk analysis, and it basically is risk rate. So all your positions, you click on your positions, and it basically has a risk rate showing you up and down and you can say 10%, 20%, 30%. And then we have a place we can do IV shot, percentages or actual points. So you can, and then we take that our option price model and reevaluate the call. You get theoretical calls, the calls and puts, and the gains and losses along the risk array.
That's a
It's a
great
really cool tool. You know,
Yeah.
it really helps to make sure you're okay with the risk, you know.
Yeah.
And then if you want to put on trades and kind of say, okay, if I buy, you can do simulated trades. Like if I buy this stuff, you know what happens. You also have the Greeks on it too, where you can kind of see the Greeks. So it's a nice tool to have. It's again, it's free. It's part of the platform,
Yeah.
and it's kind of a good thing to have in your backhand to make sure. Okay, you know, I'm assessing my risk. Am I looking good? Yeah, looking good. I mean, you got to take a risk to make money. Understood, right?
Yeah.
But you know, if you take no risk, you're not going to make any money.
Yeah.
But,
That's
Could you talk for a second about being short units? And is that in the context of like a ratio type spread or?
exactly.
Yeah. Could
exactly.
that would be interesting. Could you talk about that for a second and how you guys look at that?
So how we do is we do another margin calculation there for units. So we'll look at so like for the SPX, you know, even if the risk rates say, you know, they're way out of money, tail risk, you know, is 1 delta, 2 delta, and maybe the risk array doesn't show as much risk. We say the worst case scenario that any short option that's trades 0 cents or 5 cents, I'm sorry, can go to $17, you know, or $34 in this case for SPX. You know, we think at any point in time, those options, we've seen that through 2024, August 6th.
Or on Wednesday.
Yeah, you know,
or on Tuesday, or on Monday, or yesterday.
Those options are 5 cents and they go to $34.
Yes.
So we have an additional requirement over our standard requirement of short units, and we just basically look at short units on the call side, short units on the put side. We net them out, and then we add this $17 per short option. So you may have a higher requirement than the risk rate shows. It's just that we want to be able to help clients understand that there is short unit risk there. And so I'd rather put everything in platform and then put into your buying power. Because what I found is if you send you stuff, oh no, your risk looks bad, but don't put it in the calculation, it's more work for you and more work for everyone else. So I think the best way is put everything into the platform, and then that's your buying power, right? You know, they have any questions on how it's being calculated, you know, you can always ask us and everything else. We show in a CAP report the short units, but yeah, we call it alternate minimum. But yeah, we have all that stuff in there. But that's one thing we realized through the year is that it's a calculation that I think is really important for clients that are just selling naked options, because naked options work until they don't work. They may work, you know, if you do it 100 times, you know, it may work 99 times except for last week, you know, and so, you know, you just need to have that. So this way it keeps the clients from adding too much on. So when it does happen, you know, they won't get burned as bad.
with the naked options. You're saying if Matt or somebody has a naked option for, it's a 2 delta put, are you talking portfolio margin or just regular?
Portfolio margin, and then we do have a short minimums and Reg T also. So we do kind of do both, combination of. But for portfolio margin, yeah, we also have a short unit, mostly portfolio margin. But we also have a short unit part to our Reg T requirement too. Same thing based on short units.
So
because in Reg T, it's strategy based. You're gonna do like, you know, 20% underline, then you do 10% of strike, and then there's a short minimum attached to Reg T too.
Okay.
And we're portfolio margin. Remember, we're using an option pricing model, and then we're also including extra house requirements on PM.
So portfolio margin is basically down, up or down, what, 12%?
So how it works is the way, so there's a place called the TIMS, there's an OCC calculator.
Yeah.
And so for equities, they're up or down 15%. You know, that's the lowest you can stress any equity without being concentrated. And then for indexes, I mean, they're so bad. They're down 8 up 6, which is way too low for indexes. So what we did was we were down 15 up 10 for US indexes. So SPX, SPY, QQQ. But when VIX hit 30, we raised it to down 20 up 15. So we raised the stress levels when the VIX hit 30 to give our clients more cushion, the firm more cushion. So that came in effect like that Wednesday right after tariffs, which was actually helpful for clients because, you know, it stopped them from adding more on and trying to buy the dips, you know. And so we went to that down 20 up 15. With equities, we still stayed at 15%. And here's why. So we were trying when I came over, I think I was trying to brought over here to tastytrade. how do you figure what a concentration requirement should be? Like, what should I charge for NVIDIA per se, right? So like right now for say PM, it's 15%. For Reg T, it's 20%, right? So, and then, some people say, well, it's based on margin debit. Well, margin debit means nothing, right? I get a margin debit, long stock and long puts, have no risk, right?
Right.
So what I decide to do is you look at a 3 standard deviation move. So I do is I look at you look at a platform IVX, look at 15-day implied vol, and I take a 3 standard deviation move with it. So let's say if NVIDIA is like 80%, right? And so we just take 80% time. So you take square root of time, 365 days divided by 15 square root. It comes up to be 0.2. So a 3 standard deviation would be 0.6. We just take that number, 80% times 0.6, 48%, we round off. So we hold 50% as a concentration stress level. So if you're counting 50% with going secured, you get a higher risk rating. You're being held at 50%. If at 50%, you don't lose, your NAV doesn't get wiped out, you get back down to 15%. So this way, we feel it's a better way of clients not being too concentrated. And then, if you want to put on more trades, you buy some more puts for protection or buy calls in case we're in. So I think it's a better way of having a thing in place for concentration that's based off standard deviations, and that clients can adjust it by buying puts or buying calls. And we do the same kind of calculation for Reg T. Instead of 20%, we'll put in the 50%, and then how much on money plus premium. Same way. To me, that's a better way of doing concentration. You don't have to have 50 guys trying to figure out, how should we raise this one? My point has always been the market makers know better than we do. We can always add stuff on ourselves, but the option chain is the option chain, right?
That's right.
They're pricing out the straddles, right? So we're thinking that they're going to know better than we are in terms of where volatility is at. And then the only difference is that we do have a default of 30%, just we have a minimum. Even though it might say it's like someone can only use 18% or whatever, because FINRA wants a minimum, and so we just put a 30% minimum concentration. This way, we feel like we're protecting clients, and then if they want, they can still put position on, just have to put hedges on, right? Which is better for them anyway, in the long run. So
you're trying to protect the client from himself.
Correct, because the video everybody jumps on board, and then all of a sudden, it's easy. Like you're making money selling stuff, and all of a sudden you're not making money, right?
Yeah.
We rather have you hit singles and doubles than try to hit homers. On the short gamma side. Again, how many clients did so well when Trump came out and tweeted that, and they all bought SPX calls, 0-day calls for 10 cents. Again, that's a great trade too. The problem with the risk manager, I only see the bad trades. I don't see the good trades. That's the one thing I hate about being a risk manager. I only see all the bad ones, and then sometimes you get like this, oh my God, everything's bad. But no, there's a lot of people who were smart, right, and took advantage of it, right? It was like a lottery ticket for that day. So
that's right.
That's a great thing about trading. And that's why always you have to trade for next day, because you get opportunities like that, and then take advantage of it.
Matt,
again, all our margin requirements are hard coded into the platform.
Yeah,
so everything we do is all hard coded. For Reg T, it's gonna be, we go over the CBO manual for Reg T requirements, and so same with the OCC requirements.
Would you say the majority of your customers, is people who have a PM account, would that be very small, right? Compared to most people might have.
You have about 1,800 accounts or PM or something, 1,700. So, it's not a lot. But what I like about perform margin is that the nice part is that I like risk-based margining. I think risk-based margining is better than Reg T margin, just because, you can buy hedges and don't cost you as much, right? It's cheaper to hedge, even though you have more buying power. We don't tell clients, we should use all the buying power. The fact you have more buying power means that you can diversify your portfolio, right, with buying more hedges. So, that part I like about PM, and like being priced by option, price them out a little better than strategy priced Reg T requirements. So like for SPAN and for CME, they're all risk based. Doesn't mean so for perform margin under us, you need 150 grand to get a PM account, and then if you get below 100 grand, you have 1 or 2 days to get your account above 100 grand. The nice thing about CME SPAN is that it's risk based for whatever account you have. 2 grand, 5 grand, $1 million. They give you risk based requirements all through. Where PM Reg T, they have a cutoff on what they allow you to do for risk based margining.
Speaking of risk, we have some. Do you mind if we give you a couple questions from we kind of had our community?
Before we do that, Matt, I just got to know this one thing, because these are good regular questions. I'd love to know, the guy who's handling the risk at Tasty, what's the craziest thing you've seen?
That's me.
Yeah. What's the craziest thing you've seen?
in terms of
Just your job, like one of those days where you go home and be like, God, there's some idiots. I don't know if it's like just a real big blow up, like anything that you've seen where you're just like, this is crazy. People are nuts.
I think, I mean, I think mine is about being not proactive, like wishing the market. That drives me nuts when the clients oh no, Pete, it's gonna come back, and I just think, that to me is just like, or they'll tell me like, no, when my Vega gets X, I get out all the time, and then they don't. I had a client say, wait, no, Peter, when my Vega gets, more than 20 times, whatever, I get out of position, and he doesn't. And they're like, we talked about this, yeah, but like I'm like, ugh. You had a rule in place, right? That you followed, right? And you decided discretion wise not to follow the rule. I think that was Dan's point earlier. And that was like, you put room in your account, and I have so much sympathy for you, but like you had to, you have to take losses sometimes because you have to be in the game. And I think that's one thing that really irritates me. And then that Friday with that move and was crazy too. Like all these talks after 3 o'clock is just nuts. Like Trump and tariff. I don't know why they don't wait till 4:30, 5 o'clock. Like they don't know where the markets are. That drives me crazy too. Like if Tesla announced 3 o'clock, they should have a provision like you shouldn't talk until after market officially closed at the OTC window. That's 4:30 Central Time. That drives me the most nuts. Like you should know you have market structure people in your committees at your companies that know this stuff. And there's no reason if you're gonna make something that's you determine has been monumental in terms of your firm being a CEO anywhere, or you should really wait to make the markets close. Markets close at 4:30.
Yeah.
You know.
Yeah.
Peter, what do you
Yeah.
see with the 0-day stuff? I mean, that's a new. Are you surprised at how successful it is with the 0-day? And would you say what percentage of the customers or your percentage of your volume is just 0-day credit spreads?
A lot of 0 days. I think where they're trying the positioning is 0 days for equities now, which
Yes.
is going to be which is going back to my expiration problem. That's going to be a big problem for us.
Huge. Yeah.
Well, big clients that we're just going to close everyone out. At 0 day, should not take the risk. And they're going to be like, well, why'd you pay a penny or it's out of money? Why'd you pay 5 cents? That's going to be. We were talking about the other day, like, what do you do? Like, because it could happen. It may not happen once out 100 times, but at one time. But that part of it, and then and then clients kind of doing goofy ratios sometimes because even when you're running rec or even PM or sometimes they're in between strikes, risk points along a risk rating. So understand a 0 day when you do kind of crazy ratio spread sometimes can get clients in trouble too. Now we've done some stuff in place because how Span did it before. So Span one basically took a 1 day move. So ES, let's say right now is 9%, right? So that's how Span does it. They take a 9% move, and then they do 16 scenarios from it. So one move is 9%. Then we take a third of the move, 3%. We'll take 2/3 of the move, 6%. A full move, 9%. And then in between those, they'll do shocks, val up, val down, val steady, and all. And then you can see it on our platform. We actually have it. You can go on our gap report on our platform for ES. We actually show out the whole Span methodology. But my point was we'd have clients who trade at 2% risk and wouldn't show up in the reports because Span really started at 3%. So they create a trade where they're short the 1%, long the 4%, making money. So we actually put risk rates in between those numbers on Span. And then Span 2 came out, which is more a VAR, where they have to do a Monte Carlo simulation. So now they're kind of catching that risk. But until like 4 months ago, we had to put in risk points at 0.5%, 1%, 2%. Just to cover risk, because clients in 0 days were doing these kind of ratios where, at 3%, 4%, they're making all this money. At 2%, they're getting killed, but they weren't picking up on the risk array.
When you say ratios, are they net short contracts?
Yes.
Okay.
Or sometimes they're net long contracts. Sometimes they're short the more at the money and long 3 times of the other monies. But those other monies won't really kick in until you have that on a 0 day at 4%. So. Yeah, they're doing.
They're not understanding. They're thinking those longs are going to help them, and they don't.
It would help when it kicks in, but if it doesn't kick in that 4% number for 0 day, they get destroyed. So we had put in our own risk grades into their own span, and then finally span 2 came out, and and then for us, for our PM, we do 22 price points around the risk grades. We kind of catch a lot of those. Because
Okay.
sometimes clients construct these positions, and you guys know that all over the map, the blobs or whatever. So we kind of do that. And then the other cool feature, I know, we do, I think it's really cool. I think we're only firm I know knows it, but so at 1:30 every day, we roll your positions next day. So remember when we were trading in pits, you want to see, okay, what does the next day look? So we do now for our PME and Reg T is that we roll at 1:30, roll their roller. We basically we uncheck their long hedges, so they see the risk next day is. So anything is
Wow.
out of money, we uncheck. Anything in the money will take out resulting stock position, so will be offset. And so this way, client knows at 1:30, hour and a half to go, what they need to replace their hedges, right? So they can see it in the buying power. So we're looking at the current requirement, next day's requirement, whichever is larger, that's where applying for your buying power. I think it's a really cool feature because it gets clients who, to your point, forget about, oh, I have these hedges on. And then two, it shows them buying power, so they have negative buying power. Because we always send emails to show that, but then until you see the platform, you're like, oh, maybe it's not that bad, right? And then you've seen the platform. So we think that's a really cool feature for clients that they can see that, we're rolling that date, so they can see, oh, I got to replace these hedges, right?
Okay.
So so I think that's one cool feature that I don't think anyone else is really doing.
So that's at 1:30 every day.
Yes.
And how do they know that?
It's only effect like, if what you have expiring the next day, right? So, for like SPY and everything else, SPX, yeah. And then we'll catch them on for equities, we'll catch them on Thursday, we roll day. Or Friday, we roll day.
I do have a couple questions from our community, if you don't mind. And so we've got pretty good sized community, primarily back testing using high resolution data. And so we polled the community if they wanted to ask a real live risk manager, exposure expert, some questions. So here's a couple. So the first one is this: there's a common rule of thumb on the internet, especially on Twitter, which I'm sure you love, that traders shouldn't risk more than 2 to 3% of their account on a single trade. And the questioner asks, while that makes obvious sense for newer folks, do you think 2 to 3% risk remains valid if you're a consistently profitable trader, somebody who's a little bit more experienced? Do you guys look at risk as a percentage of total account size?
I mean, a hedge fund would, if a hedge fund lost 10% one day, would they be happy? So yeah, I mean, it depends on what you're trying to do. We try to take advantage of market opportunity. It may make sense to increase your risk. At the end of the day, it's really what your risk appetite is. So some people's risk appetite are different. Some people can take a loss, a big loss. Some people can't. So I think really the question is what's your risk appetite? If it's to be something that keep you up all night, then you should probably lower your risk appetite, right? If it's something that you're good with and you thought through and you've use a risk analysis and done all your thinking, and you have a plan, right? So maybe you have futures on that you could use overnight to hedge it or something that does happen. Like if you have a plan, then that's fine because you have a plan, in case it goes sideways, right? So I think it's really about what's the plan if it does go bad, right?
Yeah.
Like where do you get out at, right? If you sell an option for $1, it goes to $3, $5. You have a plan. And then B is it's all about your risk tolerance. Some people can take more risk and it doesn't affect their lives. Some people can't, and it does affect their lives. You don't want it where you're just not, it's affecting your everyday, work life.
Basically, you're asking people's the long run, put 2 to 3% of your risk in a trade, right?
Well, that's what a rule of thumb is on in a lot of communities, is that that's what they'll risk.
I'll tell you, coming from the option there, I never understood. I'll tell you why I never understood that, because, okay, I think it, I don't know, but I'm thinking maybe it came from, I get it, like maybe from the stock business or whatever, but let's look at it this way. Okay. So let's say, someone has 30 trades on and they have small amount, 2%. Are you diversified? I mean, what could hide, if you were, on Friday when the market went up 8%, if you had only 2% risk in 40 different vehicles, I mean, are they really,
How
they're all going to get
correlated?
hammered.
Yeah, how correlated are there?
Yeah,
Is
and
the
I mean,
question.
I'd
What's the
rather
overall?
be, so you can make an argument like, okay, so let's say, you know, Tom, because I talked to him, Tom Sosno, let's just say he's, right? Peter, correct me if I'm wrong. Let's say he's got 50 strangles on in different stocks or something like that. And I have basically similar capital and I'm all in SPX. Is it that big of a difference? Right? In other words, he's got, or somebody has 2%. I guess what I'm saying, where are you really diversified? In most cases, the people that have 2%, if the market gets hammered, what's going to be protected? I mean, Peter, what do you think? I mean, when you're in
Yeah, I mean, this is back to your back testing too. You run your scenarios, right? To see like that you're comfortable with the risk, right?
Yeah.
I mean, I don't.
That's actually that's a great point. It kind of leads into the next question is when you talk to customers, is most of your pain with people that have a back test or some sort of modeling tool that doesn't show the risk, or that they've set up their modeling tool or the back test and it doesn't show the risk properly? Or is most of the pain from people that aren't using tools at all?
Ding dong. That's to me, like and this is why I built the risk tool into the platform. Because when these conversations with clients call, if you don't have a point of reference, then it's just kind of like, it's like, well, if this happens, where we go, let's go on a risk analysis tool. Okay, take, the market up 5%. Let's take the market down 5%. Let's move up about 50%. Let's move it to next day. This is why I like that tool, because then you can go through with them and say, okay, here's what's going to happen, right? And to me, that's so when they call me up, they haven't they have not analyzed their position at all. It does, like, okay, but then I'll make them go to risk analysis tool and we'll walk through.
Right. That's great.
Because if I'm gonna spend the time here, we're gonna go on and figure this out.
Well, that's a great
then
answer.
it's just spitballing, which is fine, but I don't have really time to spitball. You have to kind of have just like, let's look through it. But once we get them going, I think so. The hard part is just get them to understand that, and once they get going, it's fantastic because that client is not going to call you anymore, because now they'll call you still once in a while, but not all the time, because now they have some for reference on, right? So I think that's really good for them to get them into the habit of, okay, analyzing risk, just like we analyze our firm risk, and so and the more they understand it, the better off they're going to be, the longer they're going to stay as a customer. Like we want clients to stay there 5, 10, 20 years. One and done doesn't do us any good.
That's right. Well, that's a great point. And kind of that question is on kind of one end of the sophistication. Here's question on the other end of the sophistication discussion. We have a lot of folks that trade time spreads, horizontal spreads, calendars, and diagonals of various sorts. And one of our members asked, what happens if you're on an SPX, so a cash settled index, if a calendar trade, and you have an unlikely scenario? What happens if the market would get shut down when the short was due, preventing the calendar from being closed at all because the short is closed, and then had another event where the long was closed as well? So a couple of hypothetical scenarios. I think people are talking about some sort of double black swan risk where you had maybe a world event on one side and then maybe on the other side as well.
Yeah, it's a great question. We had it in 9/11 when they closed down exchanges.
Yes.
So there is risk because if you're, let's say you're short a calendar spread or whatever, and then your hedge is gone, and now you're just short this call or short put, you can get killed because the rules of the game, like how the exchanges decide what they want to do with it, but possibly they're gonna those are not a hedge anymore, right? So that's the risk of that trade, right?
Yeah, we've had
the problem with calendar spreads is sometimes they're correlated between months and sometimes not. Just like there's 90 days with Trump, right? Depending on where the traders want the gamma, right? That could change depending what's happening on different cycles. So you may get you might not get as much offset you think on some of these calendar spreads, or one's in earnings, it's targeting equities, and one's not in earnings, where so there's going to be the problem where the volatilities are going to change on you, depending on how you put a trade out. But yeah, that could be, exchange thing. I mean, I'm sure exchange would take that into consideration, but that definitely is a probability. I don't know what percentage you have to assess
Right.
it. But
Right.
yeah, I mean, it's a risk.
There's just been a lot of discussion in the retail space lately about the risk side of calendars, which probably as a risk guy is helpful for you that people are at least thinking about this. But, some of the moves like in August, there were folks who had calendars that went very deep in the money, even though it's a long trade. Hypothetically, your long time, and they had to still pay a debit to close it because
Right.
market makers aren't going to help you out on a close a calendar if you let it go really deep in the money, especially
Well, and also part is as you go further in time, there's cost to carry that. There's a cost to carry that because you have to look at interest rates. So now you're depending on where rates are going to be at. So if you have a 6 month, a year calendar spread, you have to factor in that cost to carry of that trade because that person has to lend them money or borrow them money for that term out. And if the Fed, you look on the Fed curve, and if you see rates are going to change differently, that trade is going to be more expensive, right? Based on that cost to carry that position, right? So that's why counter spreads are really tough like that, and at least in a European sense. American style sense, you're fine because
Right.
you can always exercise it.
That's right.
So I'm not a big fan of trading those counters in European style because there's just, to your point, a lot of factors involved in that one. So where these American will keep in mind because you can exercise that long and get you out of that trade. So you also have a problem with the expiration too, making sure that on a print, if you have that option expiring on that print, and you have next days, then you have no hedge either too, right? If you don't roll that position out. So it's another problem with calendar spreads.
I noticed with the calendars, with I think not just Tasty, but a lot of brokerages about the same time, they on SPX required a lot more buying power. Was that something you guys were just seeing that a lot of people were just letting them go far too in the money and dealing with that risk?
They're doing these deep 2 years and 1 year calendar spreads that you can't, to your point, you can't get out. They don't cost them money, cost of carry. They let you in and don't let you out, right? Let you in for a bad price and you get out for even worse price. So we put 25 grand because we have people with, $2 grand, $1 grand, just trying to put those trades on, and then we're getting dinged on a big move, and that's our loss, So
You can do like
SPY because SPY at least you can get out, you can exercise out of it. And SPX, those credits, you buy it for debit, it can be even a lower debit, So you can turn the other way around based on the cost of carry. So
So you're saying your margin's gone up with like let's say someone does a 9
it's not so much margin, it's the fact that the margin doesn't take in the factor of cost of carry. Margin is just basically, you do 20% X, whatever. The problem with those trades is that you have to figure in the cost of carry of that trade. And that's not being figured with margin. It just, you have a cost of carry factor involved,
A lot of the ones in our community are shorter term ones, and we're not financial advisors, we're options tools, but we spend a lot of time explaining to people that when a calendar goes super, if you let a time spread go super deep in the money, the exit may not be pretty, and if you don't close the whole thing at once, that's going to have a pretty unique impact on potential margin situations.
Yeah, and that's why you're better off doing a SPY if you're gonna do that. You can trade a SPY. We don't have any restriction in terms of capital. You go at it because then you're not going to have the inverse movement of the calendar like that. So I'm saying there's another product you can trade, which is the same risk profile, right? Which will be better than one of those deep in the money SPX calendar or getting stuck in that.
Can I ask you two questions? I just had on my mind two favorite market maker type trades when we were in the pit. A reverse calendar selling a time spread, and let's say doing a ratio back spread or something. The margins in a Reg T account are crazy in those two strategies. Why? I mean, I get some of the potential ramifications, but when you think about, a reverse calendar or a back spread, obviously if the market goes up or down 10%, you're fine on either one. Why is there flexibility, or is it more of a, is there a,
It's one strategy based, one's risk based, it's just FINRA has these strategy based and these rules, right? And it's rule based strategy for IT,
oh, you're
for
right.
for PM, and it's risk based, so they're gonna look at the risk. That's just how it is. I mean, there's there. I don't think you're going to be a change. We took it forever just to change it. So they used to have FINRA used to these rules where it would be you'd charge more than your max risk in positions, like uneven butterflies or that stuff. So it took us 10 years just to get them to figure out everything should be max risk, right? So I don't think you're going to get them to change on ratio spreads and better margin. I think their point would be you're better off just going to perform margin, right? You can.
Yeah, you're right.
A better way of evaluating it, right? Because Reg T, you can pair things so much, it's hard to optimize pairing too. So clients have tons of strikes on, and then it's just a Reg team hierarchy of pairing option to get in. Sometimes you can't pair everything to be perfect, right?
That's
And
right.
so they'll call up a lot of times, oh my God, you should be holding this there, and I get it, but you have all these different trades on in different months, and it's just a way of our optimizing, the requirements. Where PM, it's pretty simple, or futures is risk based. We're looking at risk, we're stressing down 20 up 15 or down 15 up 10, whatever theoretical loss the greatest along risk rate, that's your margin requirement, easy peasy. It's much harder with Reg T with all the pairings.
That's right.
So.
And so PM accounts are 150 right now?
150 to start with, yeah.
Okay.
And then you can go down to 100 grand, if you have losses, but once you get below 100, you have to bring
it up.
Okay.
Okay.
Yeah. And if I think that's right, if you go below 150, you have 10 days to get the money back. You have to get the account back up to 150. So you're gonna give yourself a little bit of cushion.
Last question. If you get calls, you get emails, you talk to customers, if there was one thing as a risk exposure expert that you wish more people knew or more people thought about, if you could just change one thing, what would that be?
It'd be analyze your risk, analyze your option expiration risk, analyze your next day risk, and then analyze your what if scenarios of risk. That'll be my three things. If the option expiring, make sure that you're good with, make sure you're cover the risk, right? Make sure that that for next day, everything else, you're good with requirements. Stress tests, and then make sure for option, like you said before, we have stuff expiring on expiration day, cover it and move on. It's just not worth it. Keep it on position. So it goes to understand your risk, right? And make sure everything's covered, so that if something happens or you have to be pulled away or something and you forget about it because sometimes your mind drifts, right? And then oh my God, which is, and then all of a sudden you get yourself losing money that stupidly you shouldn't have lost, right? It's enough to lose money in a scenario with Trump and everything else, but it's another thing to do something that's self-inflicted, right? Meaning you knew to do better, but you got yourself distracted, right? And you didn't close it out. That stuff you just can't do as a trader. Everything else you have to react to, and that's part of taking the risk. But yeah, those things I think, not understanding your position and not getting out of stuff when you need to get out of stuff is what really hurts trading. I mean, the great thing about trading is you're always thinking. I think that's great in life. You should always be thinking. So as people get older, like myself, the fact that you have your brain working all the time, I think it's fantastic. I think that's the best thing about trading. They always say, "Oh, people are that's great," because it keeps them in the game, keeps them thinking, and I think that's really, really cool. I mean, that's me. That's my thoughts.
All right, Peter, I appreciate it. Peter, I tell you,
nice meeting
you age well, Peter. You age well.
Oh, lad.
Yeah.
We'll see what that.
We'll see you later.
I had a lot more hair when I first started, but
I understand that.
That's
I
okay.
understand. Peter, thank you so much for
Thank
being
you,
with us.
Peter.
appreciate you guys.
We'll
Appreciate
see
it.
you. All right, boy.